Hello and welcome to our 2020 Q4 investment update. My name's Jordan Gillis. I'm one of the partners here at Saltus, and I'm once again joined by Mike Stimpson, a member of our investment management team, to run through the quarter with you. So just to remind everyone, the last time we were speaking to you, we were sat here at the end of September, hopeful for some good news around the vaccines, really expecting a positive outcome around Brexit, and we were kind of very positive in general about the quarter and the future. But you've probably also noticed that we aren't in the office with the professional camera crew. We're very much in full lockdown as well. And, you know, COVID is back with a vengeance, and it feels like the NHS is creaking. So, you know, whilst we were positive, Mike, you know, are we in bit of trouble again? And are things a little bit concerning? Did we get it wrong?
It's a good question, Jordan, and I think this is where we have to sort of distinguish between what's going on in people's lives and the real economy, and then what's going on in portfolios and investment markets. Because while life is very difficult and we're locked down again and schools are closed and, you know, people aren't working, in portfolios, it's been a really strong quarter for investors as risk assets have gone up quite a lot. You know, we got the news that we'd all been waiting for in November when the Pfizer vaccine was approved, and since then, you know, risk assets have spiked, and, you know, particularly some of the COVID losers have increased the most.
And when you say COVID losers, can you just expand on that a little bit more? You know, what are you touching on there? Things like the airlines, or?
Yeah, so I mean the investments that have done worst since COVID started, you know, the ones that have sort of lagged the recovery. Lots of companies in the UK, lots of income paying investments that, you know, have performed quite poorly. You know, as we got this vaccine news, there's now a sort of path back to normality for these companies, and we've seen a big jump and a big increase in performance from them. I think the other thing that's happened is the sort of good vaccine news almost overshadowed a couple of other important bits, where the US election was decided reasonably decisively. We got a Brexit trade deal just before Christmas. You know, all, you know, really positive stuff for risk assets.
And, you know, you touched on the US election there and the kind of decisive result. And I know markets have sort of been hoping and looking at this smooth transition of power, but, you know, when you compare it to history, this has been anything but. You know, with unprecedented scenes of the Capitol building being stormed, and it's all, you know, quite unbelievable, really. Is this a concern for us and a concern for markets? You know, that old saying, when the US coughs, the rest of the world catches a cold. Is it a worry?
I mean, I think it's definitely a worry. You know, the scenes outside the US Capitol building were really shocking and not something that you would ever expect to see. Having said that, we still expect Joe Biden to be sworn in on the 20th of January. And perhaps what might turn out to be more important was the fact that the Democrats won the 2 Georgia Senate seats at the beginning of the month, which means they now control the Senate as well as the House of Representatives. And so that should make it easier for the new administration to have supportive monetary and fiscal policy, which should continue to help the recovery.
And, you know, touching on positive monetary policy, you know, 2020 was a pretty tough year with sort of every hurdle you could think of. You know, COVID, Brexit, challenges between the US and China. But it really just shows how incredibly powerful that $20 trillion of global support was in making sure risk assets remained buoyant. So how much is it monetary policy, but then how much is sentiment driving markets? Because at the same time, you see sort of a bit of positive news and stocks go up. And how do we gauge this?
I mean, I think the two things are related, Jordan. So, you know, back in March, sentiment was an all-time low. Everyone was terrified, didn't know what was happening. Then we had this huge injection of capital, and that sort of stabilized markets and also sentiment. And that is what has allowed us to have the recovery and the rally. really what that support has done is it bought time for the vaccine to be developed. And that's what we've seen. We've seen risk assets increase over the last 9 months. And then eventually when the vaccine was approved, we had another big jump. And even though we've gone back into lockdown and infection rates have increased and there's a new mutant strain that's very scary, markets haven't really moved. They don't really care. They can now see the end in sight, and we're prepared to look through what might be another 6 or 9 months of pain because we know that's coming. And that's what the 20 trillion did. It bought us that time.
And that's really helpful context for everyone, I think, in terms of what's happened. But what have we actually done in portfolios then throughout 2020 in that context? And particularly in the last quarter?
So, I mean, if we go back, the big decision that we made in 2020 was to rebalance portfolios at the beginning of April and have clients sort of at their risk budgets, and that sort of allowed us to take part in the recovery. You'll remember as we came into September, we'd taken a little bit of money off the table, just increased cash by 1% or 2%. That was put back to work as some of those worries we had became clearer. And then again, just as we approached Christmas, we took a little bit of money off the table again as we awaited Brexit news, and also really just felt like investments had gone quite a long way, and enough was enough for the time being.
Yeah, and I know, overall we did have a really positive year. Our clients' portfolios were sort of up between 4 and 18%, depending on their risk level, which was overall something we were really pleased with. But then you kind of mentioned there, Mike, around us starting to increase cash levels as we came into Christmas. That kind of sounds like we're a little bit nervous again. Is that us getting nervous about 2021?
No, I don't think so. I think, as you mentioned, portfolios up between 4 and 18%, depending on risk levels. That's turned out to be, a better than average year for investors. And as we came into Christmas, we just felt like markets had gone far enough. And when I talk about increasing cash, it's by 1% or 2%. So it's really at the margins. I think our view is very much that we expect this to continue, and, we intend to make hay while the sun shines. It is important to remember that these portfolios are invested on a 3-year view, though, and on a 3-year view, we do have some quite significant hurdles to overcome. That there are things to be concerned about. Your traditional diversifiers, that the bond market, they really offer you no returns or nothing sort of attractive, and that makes it much harder to build a balanced portfolio for clients.
And so that's a really good question then, I suppose, isn't it? Lots of people are feeling positive about equities. There's that good old saying from Warren Buffett: be greedy when others are fearful, and fearful when others are greedy. And like you say, it's tough to find diversification. So where do we feel we will find diversification in 2021 for our clients?
So I think it's a good question. It is more difficult. I think there are a couple of areas. The first is by investing with unconstrained managers. So managers who can invest all over the world, unconstrained by country, but also with flexible mandates where they can maybe go long or short and make money whether their asset classes are going up or down. The other place you can find diversification is by investing in areas that benefit from volatility. So convertible bonds is a good example. We've increased our exposure to convertible bond managers through the year, and they performed pretty well in 2020. But again, we see good opportunity there in 2021. I think if there's something that does keep us up at night, it's what you just said earlier. Our view has become quite consensus. Lots of the rest of the industry sort of feel the same way, expect equity markets to continue to go up. And the risk then is that everyone becomes too reliant on equity markets to produce your returns, and over the longer term that can play out badly. So it's certainly something that we're thinking about a lot and trying to continue to build that diversification into portfolios.
Okay, so to summarize for people then, it was a great last quarter. We made money in 2020 for our clients, which is fantastic. We were at risk for most of it, and we generally feel that this pattern will continue. But it's that piece about diversification that you've just mentioned there that sort of we're really thinking about at the moment, to make sure that our returns are well diversified and that you're given the protection that you need for the next quarter and beyond. Just another little thing from me before we finish up as well. We're very conscious that lockdown is a real challenge for people, and a really important thing for us as a business is how we communicate with you, our clients. So we're going to be doing more webinars, we're going to be trying to increase our content, and we would love to hear from you about what you'd like to hear about and what you'd like to see more of. So do please get in touch and let us know. So that's it for today. Thanks so much for joining us, and we'll hopefully see you at our next quarterly update.